All right, what's going on, folks? As always, we're trying to figure out if our audio and whatnot is working. All right, cool. Seems like we're good to go. Seems like we are good to go. All right, give me a second. Let me get all this rolling. All right. What's going on, everybody? What's up? What's up? What's up? So today, what we're going to talk about is money, right? We all love it, right? What we're going to talk about today is really knowing our metrics within the companies that we are running. So all of us are business owners, right? Real estate investors, services rendered, lawn care companies. And you know what? If you don't really truly own a business, you're still a business owner. You're in the business of you. So today for Be More Training, guys, what we're going to talk about is really knowing the metrics inside the company, right? Inside of our company financials that truly are making us money. Oftentimes there's this misconception that, you know what, if we look at our income statement, our profit and loss statement, we got all this money coming in. This money goes out, and whatever's left over, that's what we really keep. And at the end of the day, that's not the case, right? Oftentimes, there's money that's not accounted for on our income statement because it lives on another financial statement like the balance sheet. Oftentimes, we don't really account for our personal taxes on that P&L as well, right? So at the end of the day, what we actually walk home with can be different. All right, so today, that's what we're going to be discussing. We're going to be discussing those specific metrics, all right, that mean so much to us. So let me get all this opened up. We were going through our hiccups with the folders and whatnot. So let me where did I get pushed to? Oh, here it is right here. All right, so I do have a little slide deck here. We're going to go over some of the stuff on the slide deck, but we're going to keep it real brief there, right? So that way we can have a conversation. So I encourage everybody to please throw questions in the chat. If you got questions specific about your business, let's throw that in there if it starts to make sense, all right? Now, here's the key thing, guys. When it comes to really reading our financial statements, there's three main ones that we really want to know. And to kind of back it up a little bit, guys, understanding that by reading our financial statements, what that does for us is it provides us clarity, like real clarity, right? To give us those decisive abilities to say, hey, do we need to hire somebody right now? Matter of fact, can we afford to hire somebody right now? Or better yet, hey, has this person been with us for a little too long? Should we fire this person, right? All of these other things. Do we have the ability to borrow money? Or all of this money that we're borrowing, is it actually hindering us? All right, so all these different things. So as we look into the financial statements that we need, all right, it's three main ones that we're going to start with. The first one is going to be the income statement. Now, I don't know how to present. Oh, I can actually upload slides. Give me a second, y'all. Let's see if I can actually do this. Boom, boom. Oh, this is pretty nifty. This is pretty nifty. Okay, so while that's uploading, let's go over the financial statements that we need. The financial statements that we need is the first one is the income statement, AKA the profit and loss statement. All right, now this one's pretty straightforward. This one says, hey, all the money that's coming into the company minus all the expenses tells us at the end of the day, did we actually make a profit or did we actually make a loss? All right, pretty straightforward. Now, as we read that though, on these income statements, guys, all we see are numbers. That's it. All we see are numbers. When we look at the numbers, we think that that's good enough. Like, oh, okay, we brought in this much money. Okay, we profited, we lost this much. But in reality, guys, numbers, they lie to us. They lie. Let me give you an example. Go ahead and put in the comments below or just think about it. If you made $1 million this year, are you a happy camper? Are you happy? Is that a successful year for you to make $1 million? Now, in most situations, people be like, yeah, yes, please let me make $1 million, right? Now, some people, they got it like that. They're like, hey, $1 million is a little too low for me. Cool. Good for you, right? See, Justin says, hell yeah, give me that money. All right. So $1 million can seem like a lot, but now if I told you, hey, you have to spend exactly $1 million in order to make exactly $1 million, well, that's going to change the game. Now you're going to say, no, I'm not really interested in that. That's not enough. That means I basically profited zero. So you can see how numbers can lie to us, right? Percentages don't. So how do we use the income statement to tell us the things that we need to know? Well, with the income statement specifically, what we're going to focus on are things called net profit margin and gross profit margin, okay? So now, boom, all right, I was able to get the slides up. Y'all don't need to see all of that good stuff. We got a lot of stuff in the slide, but right here, right? Income statement right here, aka profit and loss. When to hire, when to fire, and more importantly, how efficient our company is. So when we talked about our efficiency, we're looking at our gross profit margin and our net profit margin, okay? Slide over here. All right, right here. So when we look at this income statement, guys, we really want to know two major things. How efficient are we before we deliver our product or service? And how efficient are we after we deliver our product or service? Now, the gross profit margin, that tells us that. That tells us how efficient we were before we produced our product or our service. All right. So what do we mean by that? All right, we go in, let's just use real estate flipping as an example. This is a very easy concept. We go out first, in order to flip this property, we got to buy the property. All right, cool. So we buy the property, then we got to do all the renovations and all that other good stuff. All right, so let's say we bought it for $100,000. Our renovations and all the other holding costs was $50,000. Then we went and we sold it later for $200,000. All right, so now on our profit and loss statement, we're going to see $200,000 come in on total income. Then we're going to see the $150,000 subtracted under the cost of goods sold, right? That was for the purchase and renovations. So our gross profit after we subtract that is $50,000. Does that make sense? Right? So we have basically our product that we sold is $200,000, but in order to prepare our product, we had to spend $150,000. All right, so that's our cost of goods sold. So that gives us our gross profit of $50,000. So with that example there, our gross profit margin, we're going to take that $50,000 that we made and we're going to compare it to or divide it by the $200,000 as the total that we brought in. All right, so in that situation, our gross profit margin is 25%. All right, 25%. So when we think about this, that's saying, hey, look, 75% of all the revenue that we generated went to us producing the product. Now I got a question. If you think about that, we haven't even gotten into our operational expenses. That's before product, not even after product yet. So is that going to be a good profit margin for us? We don't know. We don't know if that's good or bad. But that's a lot, 75% only going to gross profit. All right, so now let's talk about our net profit margin. So now we have our gross profit margin of $50,000, and now we're spending money on our business licenses. We're spending money on maybe employees and salaries. We're spending money on office supplies. We're spending money on marketing, okay? And so out of that $50,000, let's say we spent another $30,000. All right, so 50,000, we get rid of 30. Now we're left with our net profit margin of $20,000. All right, $20,000 is left for our net profit. So how do we figure out our net profit margin? Well, we take that same 20,000 and we divide it by our total revenue, our top line revenue that we made of the 200,000, which gives us 10%. All right. So a 10% profit margin or a net profit margin. What this shows us is, at the end of the day, we're able to convert 10% of all of our revenue into profitability. Now, that's what's important, right? Really understanding how much of this is actually going to be profitable. If we make $500,000, we know we're going to make $50,000 worth of profit. Does that make sense? All right, so how do we use this to our benefit? Now we already started thinking about projections, right? When we think, all right, how much profit do we want to see in the company? All right, we want to see $100,000 in profit. Okay, if we change nothing else about our systems and our processes, we know that we can get 10%. That means we need to earn $1 million in revenue. That's what that means. However, what if we actually just focus on improving these processes, right? So let's say before the product is ready, right? We talked about that $100,000 for purchase and $50,000 for renovation. What if, and so it's 75% gross profit margin, what if we were able to reduce that to from 75% to 50%? All right. A good way to think about this is those costs of goods, the purchase price and the renovations and commissions for real estate agents and sales. All of those are variable, right? That means that they can change depending on the product, right? They can change. But if we look at the after, right? After we have our gross profit, we look at the operational, the salaries, the office supplies, the licenses. Most of those are fixed. Most of those are consistent across the time, right? So those typically won't change too much. So imagine here, we take this same deal, we get $200,000 in revenue and only $50,000 now and only 50% now goes to cost of goods sold. Our gross profit is now $100,000. So now this same exact deal, we take 50% gross profit margin, that's going to equal $100,000 in gross profit. All right. Now remember, on the fixed side of the house, after the product is sold, our expenses don't change much. And in this situation, we just talked about it being $30,000. So we subtract $30,000, that gives us our net profit of $70K. $70K. Nothing else changed, guys. Nothing else changed. All we did was made our processes more efficient on the front end. Instead of going 75% of our expenses on pre-product, we went it down to 50%, and the expenses stayed the exact same. So now in this case, our net profit is $70,000, okay? And then we still divide it by our total that we made, which was that $200,000. That gives us a net profit margin of 35%, guys. 35%. Here's the key takeaway. We have this profit and loss, this income statement that tells us numbers. Cool. But if we evaluate these two metrics, gross profit margin and net profit margin, we can figure out where our inefficiencies are in the company. And then, as business owners, all we do is sit back and work on improving the efficiency. By increasing our efficiency by 25%, that was it. We increased it by 25% on the gross profit margin. Therefore, it transferred over to net profit margin. We increased our profits by $50,000. We just kept a hell of a lot more money that we made. That's the power of it, guys. Imagine going out there every day, you still making money, you changing nothing about your business style. You're just managing your money a little bit different, and you're looking at these metrics a little bit different, and all of a sudden you're making more money. Right? Doesn't that sound a hell of a lot better than spending $50,000 on a coaching program or a sales program just to find out that, all right, you spend that, now you got to go out and make more money, but your systems and your processes inside your company are still causing you to keep less of your money? You see what I'm saying? So that's the importance of really understanding these different metrics. All right. So to recap, for the income statement specifically, we're looking at gross profit margin and net profit margin. All right. Now, depending on your company, guys, or your industry, instead of net profit, you may start looking at EBITDA, EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. All right. All that is a fancy word for net operating income or net income. Okay. Again, just kind of depends on your industry that you're in. So same thing though. Same exact thing that we did to solve for this ratio, for this margin. You would do the same thing, and that would just be called an EBITDA margin. But it's the same process, same exact process. Okay. So keep that in mind. So again, income statement, make sure that we understand our numbers, but more importantly, our metrics, our percentages, gross profit margin and net profit margin. All right, the next one that we're going to look at here is going to be the balance sheet. All right, we got income statement, then we got balance sheet. These are two financial statements that every company needs, right? So when we look at this, let's slide back out of here. There we go. The balance sheet tells us, are we in balance? Are we in balance? The biggest thing about the balance sheet is this is a snapshot in time to tell us where we are on a health perspective within the company. And it's going to answer questions like, hey, are we over leveraged? Are we at risk for foreclosure or bankruptcy? All right. When we think about this and we look at the balance sheet, let's think of a scale. Let's think of a seesaw. All right. So if the seesaw was perfectly balanced, then it would just balance right there on top of the on the fulcrum, right? On whatever that middle point is, it'll just balance perfectly. Well, if we put in a bunch of leverage and we weigh things down, then all of a sudden our risk kind of shoots through the roof, right? So leverage weighs everything down, risk shoots through the roof. Well, now let's say we switch it up. We have no risk and no leverage. Well, the other part of that is we have this bunch of money, essentially, potentially, sitting there in that company not being used. And we all know what happens to money that doesn't do anything. It actually loses value, right? Because remember now, inflation is against us. Inflation is on average 3 to 4% every year. And so if you have this inflation against us, if we're putting our money in the bank and the bank ain't even paying us 1% to keep our money there, then that means every single year inflation is outpacing our bank savings and we're losing 2 or 3% every single year. So if our money is just sitting there, it's losing money. So now the question is, how do we balance this, right? How do we balance this? How do we make sure that our money is being utilized appropriately to increase a certain return, but yet it's safe enough that we have enough to pay off certain things, all right? And so what kind of metrics do we need to look for on the balance sheet? So the first balance sheet metric that we're going to look at is called the current ratio, guys. This is called a current ratio. All this means is what is our current liabilities compared to our current assets, all right? That's the formula right there. Current liabilities divided by current assets. What this is trying to tell us is to, first off, a current liability or a current asset is something that is due within the next 12 months. It's due within the year. And on the current asset side, it means this is liquid enough that we have availability to grab it within the next 12 months. Like we can actually get it out. So but most of the time when people think of current assets, they think of cash because it's right there. We can grab it. We can use it. All right. But current liabilities versus current assets say, hey, us as a business, do we have the ability to pay off all of the upcoming debts that are right around the corner? So this is something that we want to measure, our current ratio. Now, current liabilities can be anything from credit cards. Credit cards will always be current liabilities. That's a given, okay? But it also could be any type of loans or notes that are due within the next 12 months. So let's say we had a mortgage. Let's say we did hold it for 30 years and it's now year 30. Well, whatever's left in that mortgage has now become a current liability. Now, you know, without us diving too deep into the amortization and the fact that there should be no payment, my point is, if it's due within the next 12 months, it's a current liability. Okay. Now let's talk current assets. So most people like to think of cash, right? When we think of current assets, we want to think of liquid assets. All right, liquidity. Liquidity is saying, again, I can grab it pretty quickly. I don't need to wait to sell this thing, or I don't need to go through loops and hoops and all these other hurdles just to get my money out. So when we think of liquid assets, we got cash, we've got stocks, we've got bonds, we've got insurance policies, whole life insurance policies. We have retirement accounts that you could take loans against potentially. Right? Now, these are just all different types of financing alternatives. Now, obviously, the retirement accounts are not going to sit on your business balance statement, but I'm just starting to give you a couple of different ideas here. So now when we think about that, we want to always make sure that we have those reserves. We want to make sure that, so hey, look, current liabilities, $100,000. $100,000 is due, right? Well, we need to have that in current assets somewhere. But if we kept all $100,000 under current assets in cash, well, guys, remember, we're losing money on that. We're not able to balance that out. So what are some things that we can do? Well, when we buy bonds, we typically get them at prime, right? Which is whatever the interest rates are kind of turning over for. So if we're looking at it in that way, then, you know, interest rates now are, I don't know where prime is at, but let's just call everything about 7% right now. So you probably can get into a bond for about 7 or 8%. Maybe. And I haven't looked. So those who know, please put it in the comments. All right. But nonetheless, we get it at 7 or 8%. Well, we know inflation is at 4%. So, hey, at least our money's safe there. All right. It's safe there and it's going to grow. Now, the difference between bonds and bills and the rates at which they pay out the interest, all of that's important. But nonetheless, we have it in a place that's earning interest higher than the rate that we're losing money. So that's a great way to have a current asset that's not costing us anything. All right. Another one. Now, again, whole life insurance policies, typically you don't see that on your business balance statement, but that's another place where you can put it in. You can earn 4% interest. At least you're break even. You're not losing money. All right. Stocks. Stocks are another thing. Yes, you can own stocks in your company or in your business name. Now, the thing with stocks is, although we're saving it there and it's not in cash, and yes, it's fairly liquid because we can sell within about 24 hours or so, it's volatile. It's volatile, guys. So imagine putting $100,000 in stocks. All of a sudden, you need to pay $100,000 because your liabilities came up, and all of a sudden, the stock market just ticked down a little bit, and you only have $70,000. Now we're in trouble, right? So it's always a balance here. But the current ratio is a great metric for us to look at to make sure that we're not in danger. That we are not in danger. Okay. Now, in addition to that, there's two other ones that I want you guys to just consider. It's debt to assets and debt to equity. All right, debt to assets and debt to equity. What these essentially show is how much debt that we actually needed to finance our company. How much money did we need to finance our company? If we needed a lot of debt, then our next concern is going to lead to the next financial statement, which we're going to get here in a second. But we need to be aware of that because that shows that we didn't have the chops within the company to actually finance these things. We needed external financing. And you know what, man, as real estate investors, oftentimes this is one of the biggest things that gets us held up because we don't want to sit there and wait for our properties to be cash flowing. We just want to take a bunch of financing to get these assets. And then we say, oh, we'll just accumulate the money later on. Well, that puts us in a bad spot, guys. That puts us in a bad spot. When we go in there and we use loans and we purchase all these properties and we expect to collect or accumulate the cash flow along the way, that puts us in a bad spot for what happens when roof goes out. What happens when all HVACs go out? What happens when hurricane comes through? What happens when fire? All these things, right? So in reality, when we're balancing this out, the balance sheet is going to tell us, you know what, maybe we should come with a little bit more capital. Maybe we should have a little bit more in reserves prior to us going out and acquiring another property so that we stay within balance. Does that make sense? So that balance sheet is really important there, that we're evaluating it and we're understanding how to read this. Are we making a smart decision? Are we actually ready financially to purchase another property instead of it just be ego driven and saying, hey, I got 30,000, let me just buy a property. Hold on now. Is that 30,000 also covering other things within the company? Or is that 30,000 that we truly have to spend that will not affect the rest of the company? Right? All those different concerns there. So like we mentioned, by being able to study how much we finance versus our company's ability to operate, it leads us into that next financial statement, which is the cash flow statement. All right. Cash flow statement, cash flow analysis, all that good stuff. So with the cash flow statement, I want you guys to think of this as the lifeblood of the business. You guys remember Wolf of Wall Street, where he's doing, Matthew McConaughey, right? All that in his chest, the blood that's pumping through his veins. That's the cash flow statement. All right. The cash flow statement tells us, can our operations actually support expenses? And more importantly, can we actually afford borrowed money? This is huge. This is huge because a lot of times, some of y'all have done this too, right? We don't have to lie about this. A lot of times we'll go out and we'll say, okay, we're going to borrow money, private money for a property, one property. We're going to borrow more money for this project over here. We'll borrow some more money for this project over here. And then what happens is you'll get into the flip and you're like, you know what? Let me just take a little bit of this borrowed money and move it towards something else for the business, some other operation for salaries and that's a huge mistake because now what we've done is a cardinal sin, if you will. We've taken money allocated to a project to use for something else instead of ensuring that our cash flow for the operations could actually support those gaps. Because that's what cash flow is meant for. Cash flow is meant to support all of the operational gaps that we have within the company. There's a distinction, there's a difference between cash flow and profitability, right? Because let's use a flip as an example. You could be real profitable. You could make $150,000 in profit on a flip. But let's say that flip takes 3 months to accomplish, just as an example. Well, that first month when you buy the property, you're going to spend whatever, 200,000 plus another 225, but no money came in. So your cash flow for that month could be in the negative. You could be negative $40,000, $50,000 in cash flow, right? But then when you want to go and sell, now your cash flow is super heavy. And your profitability at the end of the year will reflect that you're profitable. Well, here's what, guys. As business owners, we have to focus on cash flow monthly. Because we have fixed expenses. We have expenses that keep coming on. They keep reoccurring. They show up here. They show up there. They're never going away. So if we don't focus on cash flow and making sure that our cash flow is optimized and that we're cash flow positive 9 out of the 12 months or 12 out of the 12 months, what we're doing is we're putting ourselves in a bind. And when we put ourselves in a bind, what do? We start siphoning money out of different areas of the business or from different projects so we can try to cover that gap. That's a no-no. That is a no-no. That's how we get caught up trying to borrow more money to pay off other people's debt. Borrow more money to pay money. That's the wrong way to do it. We will constantly lose money. I'll give you a perfect example. I have a client of mine brought me on earlier this year. Last year, they had done somewhere in the realm of 40-ish, 44 some odd flips, right? And they thought they were making a lot of money. Well, after I got through, I organized their books and we went back and we reevaluated it. They actually lost. They did not profit. They lost a ton of money. And they were trying to figure out how that happened. It was just like this. They started borrowing money from all these different places, being creative and not actually factoring in that during their cash flow negative months, they were siphoning some of this borrowed money, this fake money that their company didn't generate to pay all these things. So in their mind, they're like, oh yeah, we're killing it. Like, no, matter of fact, we have all of this accumulated debt that has all this extra payments of interest that our cash flow can't support. And we're just paying it off. And they lost money. And guys and gals, that happens to most real estate investors as you guys are getting started out. Most agents that are borrowing money for business loans and all this other stuff. Most business owners who want to go out and get an SBA loan or a private loan or this, that, and the third, credit cards, same concept. If we don't have the cash flow, guys, we cannot afford the debt. But yet a crutch is all of us are extended credit, and we love to use it. It is a crutch. Here's a general rule of thumb, guys, for all of our access to credit. Credit, lines of credit, credit cards, should be used to cover gaps in operational cash flow, period. Period. All right? Now, with that, we should only have it levered at max of about 50% of its credit limit. All right? So if you got a $20,000 business line of credit, at max, you should only have it levered up to about $10,000. Only use about $10,000 on it. So again, to cover the gaps of operation. Credit cards, as we all know, 30% utilization rate is like the key to make sure that your business credit stays kind of high. All right. And so that's there, but we don't ever want to go above anywhere near 50. All right. We want to keep it as low as possible. A lot of people love to take those lines of credit and those credit cards and use it to buy assets, or, whether it's computers, phones, or business trips, or it's actually real estate. And the problem is, oftentimes we don't actually calculate the cost of that credit, of that, there's interest involved in that. So at the end of the day, how much money did you actually spend? This is an important factor for us, guys. When we look at a cash flow statement, there's 3 categories that cash flow statement will show us. It's going to show us operational, it'll show us financial, and it'll show us investments, right? And during those, I'll show you a quick example actually as well. Give me a second and I'll pull this up on my end. But it's going to show us the different sections of the company where the cash flow is coming and going, which is important for us. Let me get out of here. Let's go. Let's go here. We'll see how much of the screen I can protect without showing any other information here. So give me 2 seconds. Let's go statement of cash flows. So you got your operating, your investing, and your finance activities. I'm just going to download it and share it that way. That's what I'm going to do. So give me a second and I'll bring that your way. But now you guys can start to see how important this is, right? How important it is to understand what metrics to read. Because ultimately, at the end of the day, here's the crux of it all. Here's the crux. We don't have to change anything in our business about how we're producing income, right? How many sales we're getting or whatever. And we can still make more money. We can still keep more of our money. Now it's when we start to take that internal look, that look inside of our operations, so we can start developing the SOPs, the process, standard operating procedures, the processes, the systems that allow us to be more efficient. And we focus on those metrics that allow us to be efficient. That'll get us to where we need to go. All right. So let's just take a look here. We'll move up this way. All right, let me see if I can. Oh, that's right. I can't screen share, so I got to upload this bad boy. Let me see if I can do a video file. All right. Well, I won't be able to get this one over to you. But those are the 3 activities: financing, investing, and operational, right? All right. So now that we have the understanding of the cash flow statement, we understand the 3 financial statements that we need to look at. Let's look at just some other metrics that everybody should be aware of. Okay. So KPIs, we already talked about this, right? Numbers of lie, percentages won't. KPIs that we have to have these because they're essential to efficiency. And we already talked about how do we keep more money just by improving our efficiency. That's it, right? So you only need 1 or 2 in each one of these categories. All right. Sometimes it's set by the industry. When I say by the industry, guys, if there's anybody in here who does Airbnb, motels, hotels, anything like that, An industry term that was used for revenue is average daily rate, ADR, right? That's a common one there. That's industry driven. We're not going to see that on long-term rentals. Okay, so sometimes these KPIs may be industry driven, but they're important to track our efficiency and to compare to our past performance to industry benchmarks and to help us with budgeting and forecasting. So we're going to need these, okay? And so what we're going to do is we're going to go over about 4 or 5 different types of KPIs. Now, each one of these KPIs that we go over, it's up to you to decide which KPI specifically that you have, but you must have a KPI in each one of these categories. So category 1 is going to be your revenue or top line. All right, revenue or top line. What you have here is revenue growth is one option, right? Lifetime value of a customer is another. Concentration of revenue, meaning if I have 4 or 5 different revenue streams, which one is the highest, right? Have a couple of these different KPI metrics in there for revenue. Now, the next one here is margin KPIs. We already talked about this: gross profit margin, net profit margin, and the EBITDA margin, right? These are different ones to track the efficiency before our product or service is delivered and after our product and service is delivered, right? Before we get paid and after we get paid. Now, these are very important. These will tell you so much just by simply looking at the gross profit margin. So I'll give you another good example here. Now, we talked about, we went in full depth about that flipping concept. With gross profit margin, we can understand that it's probably going to be lower on a flipping business than it would be on a wholesaling business, right? Because we don't have to purchase the property. We don't have to do renovations. It's going to be lower on an agency business for all the real estate agents and brokers out there, because we're not buying a ton of things that are needed in order to sell a property, right? All right, the next one is liquidity metrics, liquidity. This is what we already talked about. See, we already talked about current ratio, right? There's some other ones, quick ratio, working capital, all this other good stuff. But basically, anything that we need to have to measure our ability to pay off any upcoming obligations or short-term obligations. That's important, all right? Next one is proficiency. Proficiency. We got to have some sort of measure or some sort of metric that checks us I'm sorry, I was looking at Ruben's comment. So I think I can see the comments here, unless there's more comments that I'm not seeing. Y'all let me know if I'm not seeing any comments. But he also told me how to share, and I couldn't share earlier, so I apologize. But I got it now. Give me 1 second. Ruben's giving me a call. Give me one. Never mind, he hung up. All right, so just to finish off here, proficiency KPIs. He's got it. Yeah. Proficiency KPIs measures the ability to convert our marketing dollars to revenue and profit is another example, right? And so what this is saying is, how proficient are we with our marketing? Are we actually bringing in qualified leads and converting them over to clients, right? Now this is actually 2 parts here. Marketing brings them into sales, sales converts them to clients. So we actually need to review KPIs in both of these areas. Typically in sales, you'll see it as part of like your sales team or your sales member or your sales numbers. Hey, how many calls did I make? How many appointments did I make? How many appointments did I schedule? How many contracts did I sign? So forth and so on. That's sales. Now with marketing, it's a little bit different because we have to check what marketing channel did I use? Was this direct mail? Was this YouTube? Was this whatever? How many leads came in, right? What was my cost that I associated with generating those marketing channels, right? And then how many clients did I come in to bring into these leads for sales? So it's a 2-part piece here, but nonetheless it's extremely important because we need to see how proficient we are. As soon as we start to see that we're not as proficient, guess what? That's the area that we get to improve on. That's the area that we get to work on, right? And then expense KPIs. So expense KPIs are only looking at the expenses that we're spending in the company. Now, this helps us identify which ones need to be evaluated for efficiency. Guys, if we have 30 different expense categories and we are the entrepreneur. We do not have the time or the energy to go through all 30 expense items with a fine-tooth comb, right? That's after hours stuff because we're too busy trying to run the business and make money. All right. So by doing expense KPIs, this allows us to highlight which ones we need to dive into first. So how do we do this? So we can do a total expense versus category expense. What I mean is, let's say we spend $100,000 on expenses this year. All right. Now we realize that $50,000 was spent in marketing alone. Well, you know what? Instead of us diving into something like office supplies where we only spent like $5,000, let's start with marketing. Let's start with the largest expense. Let's really dive in there, break it apart, and let's see if we can figure out the efficiency here. All right. And so you can see now if we did marketing dollars for each marketing channel, so forth and so on, just like we talked about with those marketing KPIs. But this will happen all the way down. It's not going to just stop at marketing. You're going to tackle the largest one first and then work your way down through all of the rest to include general admin expenses. And general admin may be kind of difficult because we don't necessarily see a dollar amount produced from administrative services, but we are going to see the time that they generated and the tasks that they've kind of consolidated. So we might need to get a little creative here, but hey, is this person or is this position actually doing the things that are reducing the time so the income generators can focus on what they need to focus on, right? How do we develop those KPIs, right? So this is a straightforward class. You know, we're right at that 40-minute mark. We just dove straight into it. We covered a lot of the metrics that are extremely important in understanding how you make money. All right, how you make money. So as we wrap up here, go ahead and throw in any kind of questions, any kind of comments, whatever, in the comment section here. But just to kind of summarize, guys, one, we need clarity in our books. If we do not have clarity, then we are not going to understand what to even evaluate. Once we have clarity, now we need to learn how to interpret the numbers. How do we interpret? Through the metrics, through the KPIs, through the ratios. Because numbers lie, guys, numbers lie, but percentages do not. So it's extremely important that we have those pulled out so we now can learn where we need to dive into the company to work on our efficiencies, our inefficiencies, right? And as we continue to make them more efficient, all of a sudden we start to realize that our profit margin increases, right? And I shared this about one of my clients not too long ago. One of my clients has been working with me for less than 12 months now, almost 12 months. We're at 11 months. And in those 12 months, we were able to double the amount of revenue he generated by focusing on efficiencies. That's insane. Imagine doubling your revenue, doubling your net profit, right? Because his net profit margin stayed the same. We doubled his revenue. Imagine doubling your revenue simply by focusing on 2 to 3 key areas of your company. That's the power of it, guys. All right, awesome. Well, hey, I really appreciate everybody's time and energy. Anybody who ever shows out to one of these things, it's always great. I'd love to get some of the feedback. I see some of the comments. There's going to be a ton of people that watch this after the fact. Cool. If you guys got any questions, reach out, comment on the video. We'll take a look at it. And if there's any other topics that you guys want to learn specifically around this space, let me know so I can get with Ruben. We can come back on here. You know, I truly do love these. I'm a geek on numbers and finance and strategy. So let me know. Okay, here we go. We got one question right here. What system, app, or spreadsheet do you recommend? Great question. I personally recommend QuickBooks. Personally, QuickBooks Online is a great way to consolidate all the information. Once you have it in place, then you're pretty much good to go. Now, to answer your question, as far as just to clarify, QuickBooks doesn't necessarily produce the KPIs. Okay, so in addition to that, I like Microsoft Excel too. My Excel spreadsheet's real simple. I can quite literally download my QBO file, take the documents, upload it into my Excel spreadsheet, and then it produces the results. I personally recommend that you use an Excel spreadsheet specific to your company in the beginning until you find a system that works for you, because you have to customize your KPIs. Absolutely. Thank you. Thank you all for coming on and sticking it out for 45 minutes. I know sometimes finance can be kind of hard. It may not be that exciting and that interesting, but I love it. I try to, pass that energy on to you guys because, hey, this is what we do it for. Yes, we may do it for more purposes, right? But that money that we generate, guys, creates that freedom for us to then live that lifestyle that we intend. All right. Noah in the house. What's up? All right. Great question. And please correct me if I'm not pronouncing your name correctly. I saw it and I was going to say Jasmine, but I think it's Jamin. And please correct me if I'm wrong. But Jamin asked again, do you provide the services to review someone's books? I do. I do provide it. There are other companies that I can also recommend to review the books as well. So yes, I do provide it, but I can also get you in touch with several other people that do as well. So you can kind of interview and you can kind of pick whatever works for you, right? Oh, Sleevester, Bob Sleeves, how often should we sit down and evaluate our expenses? I've noticed when we're doing well, expenses seem to creep up. That is a great, great question. Here's the recommendation. You should do a monthly review of your spending. The way you do that is through tracking a budget. All right, so monthly, but you have your budget already built out. And at the end of every month, you just go back and see, hey, was I in budget or was I out of budget? All right, now just because we're monitoring it now, it's top of mind for us now. All right, so now we're a little bit more cognizant. We don't make any changes month over month. We wait until the quarter ends before we actually start to make the changes. We have to wait till the quarter ends before we make the changes because we're trying to collect that data. We want to see the seasonality of this bad boy. We want to know in the winter months, are we doing better or are we doing less? 1 month off can't really show us that. So you want to do a monthly evaluation of your expenses via your budget and then a quarterly adjustment. Ruben said he was at the edge of his seat. And then new viewer here. What's up, man? I can't even read your name out, but welcome, welcome, welcome. Is there any other questions that you guys might have around business finances, around structuring your expenses, anything like that? We'll leave it up just a little bit longer while the questions or the comments come in, because I always know there's a slight delay here from the live stream. Yes. All right. So Eddie hit it nail on the head. Cash flow equals freedom. Cash flow equals freedom. That is so important. That is so important. The details are critical. We do all of this. And yes, like I mentioned, some of this may be for a purpose. Some of you may run nonprofits and all these other things. But we have to understand that it's the money that's generated that allows us to do it. A lot of times we'll spend time and energy on hobbies that we enjoy, which is great. Great. We got to have those things. We got to have those pastimes, but we don't spend time and energy studying the one thing that funds those hobbies, which is money. So taking the time and the energy just to do a little bit of studying, set some standards for your business is going to pay extremely high dividends in the long run. Okay, yeah, and he says, hey, I'm ashamed to say I'm not as disciplined as I should be. And don't be ashamed to say that. That's perfectly fine, because you know what? Not all of us are disciplined. Not all of us are inherently going to stick to a certain regimen. But what I would say, how do we counter that, is by building in systems, right? So a system would be, so let's say for you, for example, let's say that even though you put on the calendar every Friday, I need to do this, right? But you're not disciplined enough necessarily to do that. So a system could be, theoretically, I'm going to hire a virtual assistant that does it every Friday for me. You see what I'm saying? And now I understand that that may not be the case for everybody, but that's a system now that requires the consistency. And you take the need for discipline out of it, because we're human. We're all human, right? Some of us don't like to do certain things. I'm going to tell you, like for me, although I work out all the time, I don't necessarily have the motivation to work out all the time. So I hired a personal trainer that says, hey, dude, you pay for me, you better wake up, right? And so that helps me stay to that, right? So instead of me leaning on my discipline, I lean on another system to provide the consistency. All right, Ruben asks, how long should a new business owner expect to be in the red? I see some who have an expectation of immediate results. So this is an interesting question, because here's the thing. we always need to lead with revenue. There's so many times, real estate agents in particular, guys, real estate agents in particular, they want to go out, they want to spend money on the perfect logo, on the perfect business card, on the perfect signs. They want to do all these things before they ever sold a property, or better yet, before they ever even spoke to a potential client. Why? You're already licensed. Go get a deal. Get the proof of concept first. When you do it that way, that money comes in, boom, most likely you're going to be in the green or pretty close to it, depending on your business model, right? If you lead with revenue, this question of being in the red for 9 months or 8 months, it's no longer a point of concern. Now, yes, as a realtor specifically, we got our monthly dues, we got our brokerage fees, we got our licenses that we got to pay, all that good stuff. And so that's fine. But we want to leave, we don't want to add on any additional expenses is my point here. So how long should you expect to be in the red? Well, if you do the numbers, you can identify your break-even point. But the key takeaway is don't just start buying stuff because you think you need it to run a business, which is the absolute opposite of how things should be run. All right, another question here. Do you have an Excel spreadsheet template that can be used to start tracking business budget and expenses? Yes, I absolutely do. I have quite a few of them. And I have a few courses. I have a bunch of different stuff. I don't think that I can send a link because it's a PDF. I'm not sure if I can attach a PDF here. So I tell you what, reach out to me. All right, reach out to me. I'm trying to think of the best way to reach out to me. Here we go, guys. Here we go. This is what we're going to do. If you guys have other questions, that's my company email. You guys can email me there, and I can provide you with some of the resources and things like that. Some of them are not inherently user-friendly without an explanation. So we'll work on that. But what I can definitely get you some resources. All right, here we go. Starting a business soon, but I'm having a hard time finding what I should charge because I usually do these things for little or for free. Absolutely. A lot of times when we start off, we want to do it for free or for very little because we need that proof of concept. It's more important to gather testimonials and get the experience of the transaction than it is to just start charging them an arm and a leg. So for you specifically, I would say charge what you normally charge and build up. If you don't need the money, if you have the flexibility to continue to do this for a little bit cheaper or for free, then what you're doing is you're not going to do it for free or for cheap without the exchange of something else. And that exchange is going to be a testimonial and maybe a referral. Does that make sense? So, because when you're bootstrapping, it's very hard to get clients. So I will do this for this discount, or I will do this with no expense to you. However, I would like a 5-star review or a testimonial or something and a referral. That's my recommendation for getting started. And as you start to build it out, you'll collect a lot, right? You'll start doing more deals. And then eventually you'll find yourself where you can't manage the deal load, and then you just increase your prices. That's a simplistic way of going about finding your price point. It says, I'm not as disciplined either. Again, we build systems for discipline. I made $28 an hour at my job, but 28 hours in the real world is nothing. Yeah, it 28 an hour for a service that you're doing all in by yourself from top to bottom can be challenging. So always monitor that as well. So Bob says, I've started pulling 10% from all of our assignment fees and dropping to an account named Profit. Does that seem about right for a wholesale biz? Great question. So this is something similar to the Profit First business model. The Profit account is an account that you'll siphon money off to, right? And at the end of every quarter, if we follow the Profit First business model, at the end of every quarter, you're going to take that profit out. Half of that account goes to you to do whatever the hell you want and actually enjoy your life. And the other half goes back into the company because you're reinvesting the profits back into the company. 10%, 20%, 30%, there is no right. There is no right. Because if you truly look at the method behind how we do this, the first thing is we have to make sure all the operational expenses are covered. Then you're going to want to make sure that you have all of your owner's pay, all of your payments that you need to support your family and your lifestyle is also covered, right? Then you want to make sure taxes and things like that are covered. Everything in the business has to be covered, and then what's ever left over can be considered profit. Now, we say profit first because we backwards plan into it, but as soon as money hits, 10% gets allocated out as an expense. That's why it's called that way. But as long as all of your other things are covered and accounted for, sometimes it's 10%, sometimes it's 5%. You know what? Sometimes it's 1%. But the fact that you're doing it, Bob, is great. So please continue to do that, and don't try to compare yourself to others. Just make sure those numbers make sense for you. All right. Sounds good. Thanks. Absolutely. Yeah. Reach out to the email there. Bob says too much or too little. We just talked about that, man. Just continue to do it. But you have to determine if it's good for you. You have to determine if it's good for you. All right. I'm killing myself doing things for cheap and free now. I was doing things for free when I had a primary job and I wasn't relying on the money from the side job. Yeah. So now, yes, we have to reallocate everything and reconsider. So for everything that you've done for cheap and for free previously, reach out to them and see if you can get testimonials. The more testimonials you have, the more credibility you have, the easier it is for you to feel comfortable charging an appropriate fee. And I'll just tell you guys right now, my services they're inexpensive in the long run, because when you really see the value that you get and the money that you make from my services, it makes sense. But a lot of people would look at the pricing of my services and be like, oh, I don't know if I can afford that. When it makes sense for the right people, I'm just looking for the right people, right? So that's a difference in an approach. Whereas some people may say, hey, look, I just need to get as many people as I want. Remember, guys, life is hard. You get to choose your type of hard. If you're dealing with just everybody, you're going to have a lot of people complaining, a lot of people fighting you on price, a lot of people for this and that. If you find your select clientele, the business model becomes a little bit more stress-free. All right. All right. Awesome, guys. Awesome, awesome, awesome. Okay, so we're here at the top of the hour. I appreciate everybody sticking around. I really do appreciate the comments and the questions. Again, if you guys have more comments or questions, please reach out to me at that email there. We do have a few different resources we can provide. We can also provide you with more, whatever you need. If you want more training or if you want actual service, whatever the case is, then let us know in that email as well. And you know what? There's always something that we can do. The comment says, I can tell I can never afford your services, so I appreciate you doing this live and taking time. And I really appreciate it. So thank you for your words. But there's always something that we can do. All right. So I'm always willing to point you, anybody, in a direction towards resources, towards free something. Right. If I'm not the best fit for you, that's perfectly fine. But there's always a solution. So please please feel free to reach out to me, man. If you feel like you're struggling, just reach out to me and I'll point you in the right direction. We'll get it going. Yes. Ruben says it perfectly. Price is only an issue in the absence of value. Right. So the people that argue with your price, like you're talking about, you don't know where to kind of price you at, then the issue is they probably just don't see the value for them working with you. And Justin, always a pleasure, my man. Always a pleasure, brother. You know you can reach out to me anytime. But all right, we're at the top of the hour, guys. We're going to go ahead and cut it off here. Again, feel free to reach out to me. Thank you all for attending and participating in the conversation. Always makes it a blast. I will see you guys next time.